Good evening, everybody. I hope everybody's had a good summer and is recharged and fresh for our update this evening for Chairs of Trustees and Chairs of Finance. By way of an introduction, I am Michaela Johns. I'm a director at HWB and I specialise in Academy schools and head up the team that we have here. We have 4 dedicated directors in the sector and 3 of us tonight are speaking. We put this update on every year as a way of adding back to the sector and helping you as trustees to keep up to date and to know what to expect. This session, I will be asking you to participate a little by using a poll called Slido, which you'll see is on the screen. So you can either log on www.slido.com or you can scan in that code. So either log on your computers or do that on your phone. And then throughout the evening, we will have 2 or 3 questions for you to participate in, and the results will come up live on screen. So your speakers tonight are Gary Brown, Matt Cooper and myself. And our aim really is to prepare you for the year ahead. So some practical points before we start. Please put any questions that you do have in the chat box, which should be along the top bar in Teams there, and then we'll answer them as we progress or at the end of the session. You'll see that you're already set up with your cameras off, but we as speakers will switch them on as and when we speak. We'll of course send you the slides and the documents in a follow-up email in the next couple of days so that you can share it with your fellow trustees or your internal teams. And we are recording the session, so it will go up live on YouTube as a video, and we'll send you that link as well so you can share that. So the first part of participation, we'll go on to the next slide. And the question that we have for you, really, just so we can maybe tailor what we're talking about a little bit tonight, is as trustees, what is your biggest worry and challenge for the year ahead for 24-25? Now, if you sort of type that in, and then we'll be able to see if there are any common themes between the various trusts that we have with us tonight. I'll just give you a few seconds to do that. Yeah, some headings there that I recognise. Balancing the budget is always a key one. Yes, and looking for new ways of funding. So again, maybe some of those topics we'll touch on a little bit more as we go out throughout tonight. But no, thank you. And rest assured, you're not alone with those topics. So moving on to the agenda, just so you know what we're covering, Matt is going to start by covering the Academies accounts direction changes. And I will then move on to remind you of some of the forthcoming deadlines. And then we'll touch on some of the issues that we've seen come up in recent notices to improve that are published by the ESFA. Then move back to Matt to update you on best practice around investments and policies. We recently ran quite a long session with this for your business managers back in June at the last forum. And so we'll just touch upon this briefly with you. Gary will then cover updates from the ESFA's External Auditors Forum and touch on the Accounting Officer letter that's been issued. He will then hand back over to Matt to cover changes in the Academy Trust Handbook, which is for this current year that coming. And then I will cover some areas that will soon need thinking about and decisions on for the future. As I said, there will still be questions and answers as we continue, so we'll keep those in the chat box, and any that we don't manage to answer tonight, we will come back to you on personally. It's our aim that we will finish by 7:30, but we will stay online to answer any questions that you have. Okay, on to Matt then.
Lovely. Thanks, Michaela. So we could just go to the next slide, please. Perfect. Cool. Yeah, thanks, Michaela. And good evening, everyone. So yeah, as a brief introduction, I'm Matt Cooper, one of the associate directors here at HWB, and I work alongside Michaela and Gary, specialising in the Academy School audit sector. So to start things off, going to run through a summary of updates to the ESFA's Academies Accounts Direction, or AAD, which was released on the 27th of March this year, about a month earlier than last year, which is good in terms of forward planning, knowing what's coming around. And this covers the 23-24 academic year and the accounts for the year ended 31st of August 24, which are coming up. So I'm sure everyone in the seminar this evening is aware of the AAD, but to quickly recap, it sets out the requirements and provides guidance for trusts preparing their annual accounts. The primary users of the AAD will be those involved in the preparation of the accounts. So this will include your finance staff, but also includes us as external auditors, your trust accounting officers, and obviously yourselves as well as trustees. I'm pleased to say that, again, there haven't been any major changes this year, but I will run through a few new points that have been included, as well as a few areas that the ESFA have suggested could be dealt with a little better. So first of all, there have been some points added in respect of the financial statements themselves. So I'm going to run through those in order really to clarify the treatment and disclosure requirements in some areas. So the first of these is 16 to 19 core education funding. This now requires separate disclosure within the income note in the financial statements, and this relates to any material kind of non-GAG related grants received from the DfE or ESFA. So this is going to relate to the August 24 year end, and then we'll also need the prior comparatives for 2023 as well. We suggested to your finance teams that where this is relevant to your trusts, then this type of funding is allocated to a separate nominal code or cost centre within your chart of accounts. So then really we can just pick that up and make sure it's compliant with the AAD when we come to prepare your accounts. Secondly, second addition is relating to the financial statements is with regards to the staff costs note and relates to other employee benefits. So in line with accounting standards, there's now a requirement that these must be separately disclosed. So examples of what's classed as other employee benefits include non-monetary benefits. So that can include things like medical care, housing, cars, and free or subsidised goods or services for current employees. So similar to the first change, we've asked for any relevant costs here are just nestled away into a separate nominal code or cost centre, and then we can pick it up and make sure it's disclosed correctly. Thirdly is with regards to the valuation for initial recognition of long leasehold premises, seeing as most schools that convert to academy status continue to occupy the premises occupied by the predecessor school on a long-term basis, but do not acquire the freehold. So where this does occur, the value of the premises needs to be determined in order to recognise them initially as an asset within the financial statements. So this has always been the case, and nothing has changed with regards to how these premises should be valued. However, the AAD this year has provided some further options of how to ensure that this estimated value is compliant with the accounting standards. There's 6 ways that they've mentioned in the AAD, and then just to mention a couple tonight. So firstly is kind of obtaining a valuation from a chartered surveyor. Secondly, obtaining a valuation from the local authority, and also obtaining a valuation from a construction company where appropriate. There are other methods included within the AAD, and it will be on a handout we provide later. So where this is relevant to your trust, then it will be important that you as trustees consider which valuation technique is deemed to be appropriate, obtain that valuation whilst also considering value for money as well. Of course, we're always available to support and provide guidance if unsure, and have had these kind of conversations with our Academy Trust clients previously. And then final change surrounding the financial statements is with regards to agency arrangement disclosure. So accounts now require disclosure of cumulative unspent fund balances as at the balance sheet date, as opposed to previously when it only required disclosure of in-year movement. So just a subtle change there, just to make sure that kind of this total amount which is outstanding at year end is disclosed fully. So similar to the top 2 points earlier, again, where it is relevant to your trusts, we've asked your teams just to allocate all relevant transactions into a separate nominal code, so then we can make sure that it's disclosed appropriately. So moving on to the next section. So aside from changes that directly impact on the financial statements, the AAD also includes some updates on other related matters. So firstly, there's a new section called What an Academy Trust Must Do, which aims to highlight the key requirements in relation to an Academy Trust's accounts. It is a fairly long list, so just going to highlight a few tonight to give a type of flavour of what it covers. So prepare accounts for the Academy Trust financial year, ensure the contents of the accounts complies with company law, charity law and the AAD, ensure a governance statement is included, have the account audited, ensure that there's an accounting officer statement, etc., etc. So these are all areas which kind of assisted by us as your external auditors, where we ensure compliance. And it's a good reminder for yourselves and for your finance teams of the relevant requirements as well. Secondly, this year's AAD includes one further example. There's a example for a source of information to inform the accounting officer's statement, as they must ensure the Academy Trust is working within the boundaries of regularity and propriety. So this additional source reads as review of other external sources of assurance available to the Academy Trust over the year, for example, specialist reviews or inspections. So therefore, our suggested action here is ensuring that your accounting officers are aware of this new requirement and information contained within it is considered as part of their oversight of internal controls. So thirdly, in keeping with the DfE's push to get more trusts to adopt their chart of accounts, they've put a section in this year's AAD which explains one of the benefits, that being that there are synergies between the accounts and the accounts return due to the structure and mapping included, along with what they call their automation technology available as well. So adoption is on the rise due to increased efficiencies between the financial statements, accounts return, budget forecast return. They do remain optional for the time being, and have been ever since they were launched in April 19. Time will tell really as to whether or not they will become mandatory at some point in the future. So again, as trustees at this point in time, would advise that you're aware of the pros and cons of converting to the DfE chart of accounts, ensure that it's on your finance team's radars, which I'm sure it will be. Moving on, there's a new conclusion with regards to internal controls that must be reviewed and disclosed within the governance statement in the accounts. This will need to include a positive conclusion if this framework is in place, or if it's not, it needs to confirm that it is not, along with the trust's plan for improvement to bring it in line. So the specific wording there is review of the effectiveness of the system of internal control must conclude whether the Academy Trust has an adequate and effective framework for governance, risk management and control. Therefore, in this instance, I would suggest again that you and your accounting officers are aware of this new conclusion requirement and that it is included within your trust governance statement accordingly. Next, just really briefly, to confirm that all references relating to COVID have been removed from the AAD this year, seeing as all COVID-related grants have either stopped or become business as usual. Then finally, as has become customary each year, the AAD provides an update on ESFA feedback to the sector on the outcomes of its assurance work and compliance with the AAD. So from the ESFA's review of the August 23 accounts, along with the audit findings reports and internal scrutiny reports, it's identified a few areas which it states will help trusts improve compliance with the AAD. It's quite detailed in the AAD, so just going to kind of really briefly summarize here, and if you wanted to go away and kind of read into more detail, then obviously you can. So there's 5 areas. One was statutory submission deadlines being missed. Second was wording in the accounts being taken directly from the model. Thirdly, actual internal scrutiny arrangements not matching what is disclosed in the governance statement. Fourth, high risk points from audit findings reports being carried forward from one year to the next. And then lastly, mandatory parts of the accounts being omitted. For example, statements relating to estate management, which was kind of new last year. So in terms of the points relating to accounts disclosures, we ensure that this won't occur for our clients. And also when it comes to high risk points on our audit findings reports, where we do issue high risk points, we'll follow these up with your finance teams during a year to ascertain what progress has been made, really just with the aim of ensuring that these points don't get carried forward from one year to the next. So yeah, suggested action here for your finance teams here is to review the detailed feedback included within the AAD, and then if any points are relevant, then ensure plans put in place to improve their compliance. So I think, like I mentioned earlier, all these changes have been summarised on a fact sheet that we prepared and circulated earlier this year, and we'll be sending that around again after this seminar with other links as well. So yeah, that's all on that part, and I'll pass over to Michaela, who'll take you through the 24-25 timetable for financial returns. Thank you.
Thank you, Matt. So this really is just hopefully a concise summary of deadlines coming up for you. So the first one being the Land and Buildings Collection Tool, which the deadline this year is the 4th of November. This form that needs to be completed has had very little focus on by the ESFA over the years, and no penalties, no sort of name and shame moments if you don't get it in on time. But we are now seeing that there is more and more interest in it. So as auditors this year, we might spend more time reviewing this return, as we've been made aware that some have not been completed as the ESFA want them to be. And this is particularly more of a problem if you are a diocese school or part of a MAT that has diocese schools within it. So yeah, a little bit of advance warning. Then obviously following the audit season over the next 2 or 3 months, the audited accounts, the audit findings report or management letter, and the summary internal scrutiny report will all need to be filed with the ESFA by the 31st of December. Following that, you then move on to the Academy's accounts return, which needs to be in by the 18th of January. And then the accounts themselves need to be posted on your Academy Trust website by the 31st of January. And the return of the school's resource management self-assessment tool, a little bit of a mouthful, but that return is estimated to be needed in by the 14th of March. They haven't released a date on that, but that was approximately when it was last year. So just to give you a little bit of advance warning. The accounts themselves don't need to be filed at Companies House until the 31st of May, but what tends to happen is they get filed once they're signed, so early January normally. And then finally, the budget forecast return. Again, this date hasn't actually been announced yet, but expected to be the 31st of August 25. So out of all of those dates and deadlines, the ones that you as trustees need to see and sign off and approve are obviously the accounts, the final internal scrutiny report, and the budget forecast return. The other forms, particularly the RMSA tool, will normally have your consultation, but it would usually be the business manager who submits them on your behalf. Okay, so that was just a really quick run through on the deadlines coming up. I think we're going to move on now to notices to improve. So these are public notices that list issues found by the ESFA on particular academy trusts, and they then have to action these points in order to then come off of that list to no longer be on public record that there is an issue within that academy trust. So before it gets to that point, it means that there have been several informal interventions by the ESFA which have deemed not to have worked, and therefore they've had to take it to the next step of issuing this public notice to improve. So it's quite refreshing that there has only been 4 notices to improve issued since the 1st of January this year. And this follows last year's pattern when there were only 3, which I think really that means the sector is now more compliant and probably a little bit more mature, and that the academy trusts that weren't run very well have now all been subsumed into more well-run sort of MATs in general. So the first bullet point there that I've listed was a school, the John Henry Newman Catholic College, based in Birmingham, and their issue that the ESFA had with them was around the non-disclosure of related party transactions with their sponsor. And this wasn't just a one-off, this was persistent. But for 4 years, they've not disclosed this related party transaction, and it was significant. It was about £500,000. So I suppose the sort of learning sort of question for yourselves as trustees is do you know about all the relevant related party transactions in your trust, and have they been appropriately reported to the ESFA or prior approval obtained? The second case, again, not picking on Birmingham, but another trust in Birmingham, the Cromwell Learning Community Academy Trust. Again, had a pattern of reporting better forecasts than achieved. And again, this was persistently done and became even more of an issue because they were already in a deficit position and they continued to be overly optimistic with their forecasts. So from what we know of our Academy Trust clients, I know most of the other way round. They usually try and predict the worst case, and then the final figures are better. And we all know that you're all dealing with estimates, because when the timing of when you have to do the budget forecast return isn't very convenient, and therefore you have to make some estimates, around sort of announcements around salaries and pensions and things like that. So moving on to the third bullet point there, spending for incorrect purposes. This was Mowbray Education Trust, which was based in Melton Mowbray. And this was around how they had spent public funds and were they being spent for the correct purposes. So I think there all sorts of things were happening, which included sort of conflicts of interest issues. So quite a complex one. And again, you can see why the ESFA were interested in them. The final point there was a trust in Redditch, Walkwood Academy Trust. And this was on financial management grounds, and in particular, the management of the cash position. Their words were around the lack of robust oversight by trustees. That sort of constructive challenge is still seen as very, very valuable. This wasn't helped in this Academy Trust by poor controls. And also, to top that the accounting officer did not report their concerns either to the ESFA, and so they were named in the report as well. So in all of these notices, there is a section on what actions the ESFA want to see change and happen, and a timescale, and that's all agreed with your sort of internal teams. And in general, the ESFA are quite supportive and will offer you some sort of assistance with your plan, and signpost you to various places to help you get to that stage. So my advice to you really is to register for these notices. They are on the ESFA website. And as they're posted, please do read through them and see if anything rings true to you. Could that issue happen within your Academy Trust? And then make it an agenda point on your next trustees meeting and discuss it with your board or your business manager. So I think the sort of learning lesson from all of this is, learn by others' mistakes and make sure your systems and procedures and controls are strong enough to pick up any issues. Okay, I will finish there and hand back to Matt to cover investments.
Perfect. Thanks, Michaela. Yeah, so as Michaela mentioned earlier, we did include quite an extensive section on investments back at our Forum for Your Finance teams back in June. I thought it'd just be a good idea this evening to go through a summarised version of this area again. So, obviously, just to point out, obviously we're not investment advisors, so can't advise on where investments should be made, but this section today will hopefully give some more information and a bit of food for thought, really, in terms of the sector. So, going to start quickly with just a quick bit of analysis from the August 22 Academy School sector financial statements, which is the latest published figures for the sector as a whole. The last couple of years' reports have been published about 18 months following the year end, so we'd expect to have the August 23 full Academy sector accounts by around February next year. So as you can see, across both non-current investments There's going to be kind of certain investments which are held for more than a year, and then cash and cash equivalents, which is more liquid funds and will include cash held in current accounts and deposit accounts, which mature typically within a few months. There's a total of over £6.8 billion of cash across the sector. So this is predominantly held in cash and deposits, and in total is an increase of over 800 million when compared to the same balances as at August 21. You'll also note that a majority of that is included within the cash figure on that screen, that's 6.674, as opposed to longer term. Unfortunately, the analysis of how this is spread between kind of how much is sat in a normal current account, bank account, and how much is on shorter term deposit accounts, which I'll cover shortly, isn't published. But there will certainly be an element of surplus cash sat in low interest current accounts included within that 6.674 figure, which could be attracting better interest rates. And then on the third line now on the screen, the amount of investment income, which is essentially interest received, increased by £1 million up to £6 million, in line with expectations due to increased interest rates in that year. I'm actually quite eagerly anticipating the 23 sector report to be published, as I suspect that this investment income figure will increase quite substantially, not only due to further increases in the base rate during the year ended August 23, but also due to kind of Academy Trust perceptions of earning more interest on surplus cash changing during the year. We've been pointing this out to our clients since rates started to increase, because the amount of interest received can be quite substantial in some cases, and even enough to fund a teacher's salary. In terms of the Academy Trust Handbook, the ATH, again something I'm going to cover later. So I'm sure you're all aware by now of the difference between musts and shoulds. In fact, up until 2013, rules surrounding investments within Academy Trusts were only a should. The AFH, Financial Handbook as it was known then, from September 14, introduced relevant musts in relation to what the Board of Trustees had to consider. And this has been subtly tweaked since, but broadly remains the same. So it currently reads as the Board of Trustees may invest to further the Trust's charitable aims, but must ensure investment risk is properly managed. And then when considering an investment, the board must have an investment policy to manage and track its financial exposure and ensure value for money. Exercise care and skill in investment decisions, taking advice as appropriate from a professional advisor. Ensure exposure to investment products is tightly controlled, so security of funds takes precedence over revenue maximisation. Ensure investment decisions are in the trust's best interests. Finally, review the trust's investments and investment policy regularly. So it is vital, therefore, that all of the above factors are taken into consideration and documented as such within your trust's investment policy, which I'll touch on towards the end of this section. The handbook also makes reference to the Charity Commission's guidance called CC14, Investing Charity Money Guidance for Trustees, which, if you've not already seen, would be a very useful document to look at. It was last updated on the 1st of August 23, so about a year ago. So if you could potentially review that in line with your investment policies at a future board meeting, if not done so already. In short, that CC document confirms how charities invest so that they can further their charitable aims along with specific legal duties and decision-making processes attached to each. It also states how, if trustees have considered the relevant issues, taken advice where appropriate, and reached a reasonable decision, then they are unlikely to be criticised for their decisions or adopting a particular investment policy. Excuse me. Moving on to interest rates. So since 2009 up until 2022, interest rates have been historically low, mainly held at about 0.5%. However, the base rate started increasing from late 21 onwards, peaking at 5.25% in August 23, which was held for a full year through to last month when it was reduced by 0.25% to 5%. So with this in mind, over the last couple of years, there's certainly much more scope now than there used to be in terms of investing surplus cash to generate some much needed extra income. So in terms of current interest rates, we're currently seeing a range from UK high street banks of about 1.7 for an instant access account through to about 3.5 for a 12-month fixed term. This is compared to about 4.3 for instant access and 5.1 for 12-month fixed term for like other UK banks. And these are still FCA and PRA regulated with a UK banking license with investment grade A+ credit rating. So there's certainly scope for improved return when considering where to invest surplus cash without increasing the risk profile, which is quite rightly included within the handbook's rules. So as a quick example then, just keeping the figures really simple. So for a £1 million cash balance at the 1.7% I mentioned earlier, you'd receive 17 grand interest, which in itself sounds like quite a nice return. But with a bit more thought, this could be more around the 50,000 mark. So if surplus cash was being invested differently, bringing in an extra 33 grand a year simply by placing money in higher interest bearing accounts. So certainly worth considering. Another area which can be used by trusts is the use of investment platforms, which have various benefits compared to completing this on your own. This is where the trust would have one account with one of these platforms, and then within this one account, various different investments or deposits can be made. So firstly, this means there's only one sign-up process, which reduces the admin burden, and it has a single online portal to access, manage, and transact on all deposits within a platform. Secondly, they claim to have enhanced rates from banks, which are not offered directly to clients. So here, this could result in higher returns and deemed value for money. Thirdly, they track all their bank's credit ratings, which can be requested. So you, again, have like that one focal point where you can track and manage the credit ratings of the institutions where the trust has invested. So as a quick example of how this could work, say you have an investment pot of 340,000, which you want to put into this platform. You could then split that into 4 pots of 85,000 each, which then fully receives the FSCS protection, split between different maturity terms for the cash flow wise, which we'll touch on shortly, and then provides more flexibility to the trust. Finally, on this point, so of course, their service does come with a fee, which is typically around 0.1 to 0.2% of the amount deposited on the platform. So again, this must be taken into account when deciding whether or not to invest separately or whether or not to use one of these platforms. So moving on to types of deposits, this can be a bit of a minefield, especially with all the different products that the banks are offering. So I thought I'd just summarize them quickly here. So firstly, we've got kind of just current account. So, that's going to be your trust's main account, your school's main account, where its funding is received and it's used operationally on a day-to-day basis, but it will likely have a very low interest rate. Secondly, we have easy access. So no notice is required on these accounts to make a withdrawal, and funds are usually back in your main account within a few days, maximum up to 5 working days. Thirdly, are called notice accounts, and these are typically held for between about 30 and 90 days, give or take. These funds cannot be withdrawn during the length of deposit without giving the required notice, but within that, the interest rates are still variable. I'll touch on that shortly. And then lastly, kind of what's called fixed term deposits. So these funds cannot be withdrawn until the deposit matures, but the interest rates are fixed as to what you fix in on day one. So, and then these deposits tend to be for around 3 to 12 months. So like I said, on that number 3 then, notice accounts, a tip here with regards to them is be wary of them in an environment where rates are expected to reduce, which could be relevant currently over the next year or so, or longer. Because on these types of accounts, the lender can reduce your rate even when you're within it by giving you 14 days notice, meaning you may end up with less interest on one of these types of deposits compared to a fixed term deposit. There is actually a bullet point missing. So the next bullet point should be surplus cash, which I'm just going to mention now. So, and then what I wanted to confirm is kind of what I mean by that, what is meant by surplus. I was fully aware of the budgetary constraints across the sector. So you may be sat there thinking, we're making deficits each year, so we don't have any surplus cash. But yeah, even if your trust is making in-year deficits, it could still be that there is this surplus cash sat in the bank, which could have accumulated in previous years or upon conversion from local authority, perhaps. So when I say surplus, I'm essentially referring to the cash within your trust's bank accounts, which is not required on a month-by-month basis. One thing we covered at our forum in June for your finance teams was to look back at your trust's month-end cash balance over the last, say, 12 months, as the month-end tends to be the lowest in the month as wages have just gone out and the funding is yet to come in, and then see what the lowest level was. You can then kind of forecast forward using expected income and costs over the next, say, 6 to 12 months, and come up with a forecast cash balance showing the amount of cash that is needed to meet the school's operational requirements. and then also build in any planned capital works, for example. And then once you've got your known amount, anything in addition to this could be deemed surplus, as it won't be used. So again, another example, just keeping the figures simple. So again, let's say your trust has £1 million in the bank, and your finance team's analysis over the last 12 months and then forward into the next 6 to 12 months is that the balance is not forecast to drop below 800,000. Excuse me. You could then build in a buffer of, say, an extra 50 to cover any anomalies, being risk adverse, leaving you with 750,000 of surplus. So this amount could then, say, just as one example, split into 3 pots of 250. So you could then potentially deposit 250 into an easy access account. So should extra funds be needed in an emergency, they could be withdrawn in just a few days. 250 then could go into, maybe let's call it a 1 to 3 month notice account, perhaps, where the interest starts getting better. And then the final 250 could kind of be locked into a 3 to 12 month fixed term, achieving the best interest possible, as the likelihood of ever touching this kind of bottom amount following your finance team's analysis would be deemed very low. Yeah, of course, that's obviously just one example. And then in conjunction, and then for you, in conjunction with your finance teams, would need to assess obviously what's suitable for your interests. And then finally, I just wanted to mention the actual investment policy itself and then what it should cover. Well, firstly, it clearly needs to comply with the handbook, but in terms of a few ideas, it should be saying it should state what the trust's powers are in respect of investments included within its articles. Also confirm the general objective. So this could be the investment of surplus funds to obtain a superior return when compared to returns received from the main bank account. So thought would need to be taken in terms of what is deemed surplus, as I mentioned just now. For example, kind of just ensuring immediate financial commitments such as payroll and supplier payments are covered, and kind of trying to find that low point in terms of month end, looking back and forwards. And then also what the trust's risk appetite is. This would be low risk deposits, as covered earlier, and then also any authorization limits. So it could be that your CFO can invest up to an agreed amount, with then the CEO or yourselves as trustees having to approve investments above a certain amount or over a certain amount of time, perhaps. And then just to finish on, we do have a template investment policy statement, which covers all the mandatory aspects. So we'll be circulating this around following this evening session, along with the Charity Commission's guidance I mentioned earlier. Which could be used as a starting point for a trust without a policy, or simply compared against your current policy to ensure all relevant aspects have been covered and are up to date. So that's everything I wanted to cover with regards to investments and policies. But of course, if any questions do come either during today's presentation or afterwards, please do get in touch and be happy to help. Okay, so I'm now going to attempt to move into a quick poll on Slido. So just to get some ideas and trends from across today's attendees. So remember, as Michaela mentioned, it is completely anonymous. We'll be able to share the results when we circulate our slides following today's webinar. So the question is, when did you last approve your investment policy? An interesting initial poll there. Okay, so the options on your screen, within the last year through to over 5 years, and there are a couple of options of either never or can't remember. As I can see, it's coming up. Quite an equal split there. I'll just be quiet just for a few more seconds just to make sure everyone's got enough time to put in their poll. Cool. Okay. So yeah, based on what I've covered this evening, it's good to see that 43% has been approved within the last year. So that's good. I imagine it's been at the forefront of minds more in the last couple of years due to the increase in interest rates, and hopefully they're in line with the ESFA's and Charity Commission's guidance of what makes a good investment policy. Obviously, if there is anyone this evening who has not seen this for discussion, we've got nevers and can't remembers within the last few years or can't remember, then I suggest reaching out to your finance teams to ensure this is in order, kind of on their radar, just to make sure that where you do have potential surplus cash, then your trust is maximising its potential when it comes to earning some extra interest. Lovely. Right. Thank you very much for listening and voting on the poll. I believe I'm now passing over to Gary for an update on some recent accounting officer letters. Thanks so much.
Okay. Yeah, thank you, Matt. Thanks for that information on investment platforms and policies. As Michaela mentioned at the start, my name is Gary Brown. I'm one of the audit directors here at HWB. part of our Academy servicing offering. And over the next few slides, I was going to take you through letters to accounting officers, and also feedback from one of the auditors forums which took place in April 2024. So starting with letters to accounting officers. So these have sort of been issued on a fairly sporadic basis over the last few years. So we've seen a general decrease in the number of letters that have been going out to accounting officers. Probably peaked around COVID time when under the previous chief executive. We've seen a couple this year that have come through from David Withy, the chief executive of the ESFA. So there was one in May 2024. So this coincided with the announcement of the election that took place on the 4th of July. So this pretty much just said, look, there's a lot to do. We're in a pre-election period, so don't expect anything new, novel, or any new announcements on fundings to come through. So we knew there would be a pause in things to come. So at that time, we hadn't had the Academy Trust Handbook. So they were saying there's going to be a delay in issuing that because it needed ministerial approval. You'll see later on that has now been issued. It also just reminded trusts as well of the 2024 budget forecast return deadline, which is now passed, which was 29th of August 2024. So hopefully your trusts have managed to get those completed and submitted on time. Moving on to the 31st July 24 letter, again, a very short letter. This was just to announce that the Academy Trust Handbook 24 had been issued. I won't go into the detail. Matt will cover that later in this presentation. With both of these letters, it's important really that they go to the accounting officer. The clerk should really share these with the trustees so that if there's any relevant points, they can be shared and discussed at the next board meetings. Like I said, it's been quite quiet on the accounting officer letters, just one or two each year for the last 2 or 3 years since COVID. Moving on to the Academies Forum, which is our auditors forum. So just to give you a bit of sort of context of what this is about. So this is a chance for auditors to meet the ESFA, to discuss concerns, challenges that they might be having in their role as auditors, any feedback they're getting back from their trusts, any questions that trusts are raising with them. Hot topics have been things like the LGPS over the last few years, especially moving from obligations to asset positions over the last few years. And also the way that actuaries deal with the trust and deal with auditors as well. So has been a topic of concern. So we were due to have one last autumn winter, but this coincided with the audit season. So auditors were not keen to attend this one, so they cancelled that one and they put it back on for April 24. So over this slide and the next one, I'll just be taking you through some of the topics and insights from that auditors forum. So starting with the slide we've got up, so we're presented with the headline outcomes from the filings work that had been done pre-Christmas. So the accounts, the audit findings reports, etc., that have been submitted. So to have a chance to collate the information, and starting with the pie chart in the top right corner, there was a 95.1% of trusts submitted their year-end returns on time. Now the report there was that it was getting worse. 121 trusts did not meet the deadline, and there was a further 16 which at 23rd of April had still not met the deadline. So they were concerned that things were worsening. Most likely those 16 were to do with financial distress, going concern issues, staffing issues, etc. But we don't have that information. Michaela mentioned another return earlier about the school resource manager tool. The deadline for this was the 15th of March 24. Similar deadline next year. 352 trusts had not met the deadline of the 15th of March, which is quite concerning. So the overwhelming theme was there: can auditors remind clients that these deadlines must be met and help where we can. That school resource one is an important tool, because it's there to check the governance arrangements and check resources have been directed to achieve best outcomes. So very important. Moving on to audit opinions. So in the bottom left, we've got the bar chart. So from left to right, so we had quite a few different audit opinions, so not all audit qualifications. So we had 48 what we call emphasis of matter. So this is not an audit qualification, but it's an audit opinion, or forms part of the audit opinion. And this had gone up from 6 in the previous year. So these are generally used where the auditor wants to reference some disclosures that the trust has made in their audit financial statements, perhaps do a going concern, perhaps do a LGPS, but something which just needs to be brought to the user's attention. The second one is looking at material uncertainty. So over the last few years, material uncertainty type audit opinions or disclosures have increased. So material uncertainties are really sort of a bit of a flag. Again, not an audit qualification, but a bit of a flag just to say that there are some major uncertainties which are pervasive to these accounts, which, if those uncertainties come to light, then could cause issues for the trust, perhaps going concern issues. But at this point in time, there's too many uncertainties to without putting a disclosure in, to actually not sign off that audit opinion. The next one is to do with basis of the going concern. So there's 150 reported this year versus 135 in the previous year, so up. These tend to be used where there's no alternative other than the trust to cease operation as a going concern, or perhaps the trust is going into another trust, and so that's often the structure of the audit opinion that's given. And finally, on that bar chart, we got the ones which are the more concerning. So there's 10 qualified reports, up from 6 in the previous year. We don't know whether these are what we call disclaimers, where perhaps the auditors haven't been able to get the information to finish their audit or to come to a conclusion, or it's an adverse opinion where perhaps they just do not agree with the trust, and there's material misstatements that the trust has refused to put through that the auditors require. So an increase. These are, like I said, these are qualified reports. Probably these are perhaps to do with LGPS. I know a lot of auditors have expressed concern as to getting information to form an opinion around the LGPS pension scheme disclosures. And what we don't know is how many of those last 16 that were not filed may come through with modified audit reports on as well. So we might never know. So moving on to regularity exceptions. So the bottom right chart. So submit these these are exceptions which are put into the audited accounts. So there's 184 versus 209 in the previous year. The top 3 or 4 don't really change each year. So number 1, number 2 are internal financial reporting and related party transactions. So internal financial reporting, we're talking things like management accounts not being shared with the board, perhaps they're not even produced at all, or produced on a timely basis, or even things such as the website, not updating the website at all for the trust. And then the related parties, so just a lack of disclosure to the ESFA, or even perhaps pre-approval to the ESFA if the numerical numbers have been met. Third, lack of internal scrutiny. So perhaps they just maybe had 1 or no internal scrutiny reports or visits completed in a year, not basing that on their risk register. And then number 4 is alcohol, which we see on a fairly frequent basis. Just as an aside, and on the related party transactions, ESFA have issued quite recently a related party disclosure checklist that trusts can use, that you can use to consider when you are reporting to the ESFA that you've actually considered that the related party transaction is there for the right reasons. It's transparent. There's no conflicts of interest, and it's there for value for money as well. So, so if you need a copy of that, please let us know. I'm more than happy to forward it on. That's been issued in the last week or 10 days. Finally, on the assurance feedback, so there's also I suppose points that come up as part of the audit which go onto the audit findings report. So the number of points on the audit findings reports on average increased from 3.8 to 4 across trusts, and perhaps the figures just to highlight in red there are that there are 307 trusts that had high priority risks. So these are really the risks that ESFA want to be seen to be cleared in a timely manner. Don't have the comparative number, but the feedback from the ESFA was that they were not really seeing too much change in the number of high risks being reported. And the 914, so these are the risks reported at all levels on audit findings reports. So these are the sort of risks that are not changing each year, they're just repeating year on year. So really the point here is they've got to be cleared. Potentially the auditor could elevate those risks in the next year because of the fact they've not been cleared in previous years, and therefore the trust not taking timely action with those risks. So that's it on the headline outcomes. Please do put any questions in chat if there's anything that you just want to follow up on. Okay, next slide, please, Emma. Okay, so some other topics which were discussed at the Auditors Forum. So one thing we've been trying to push for, and really, is the fact that there is a lot of professional judgment that needs to go on to what goes on to an audit findings report in terms of points that we raise versus what actually goes on to as an exception in the accounts. We're not going to get anything from the ESFA on this. As Matt alluded to earlier, what they did almost partly as a concession, really, they just put something into Annex A on the AAD, which basically just reiterated the importance of clearing those high risk recommendations that the auditors are finding on audit findings report. So they've updated the consequence, the improvements that they would like the trust to be making. So like I say, that's in Annex A if you want to read that, but just stressing the importance of making sure those audit points are cleared each year. Closer alignment of actuaries, auditors. So again, this is to do with LGPS. So there's been a lot of confusion around what actuaries do for trusts, how to interpret their reports, and we've pushed for more clarity, especially when at the 11th hour you get requests from the actuaries saying, do you want an asset ceiling report, and trying to decipher what an asset ceiling report actually means, especially when it comes in really late, is quite tricky for the trust and for us as auditors. So at the last Auditors Forum, they have actually issued an Informa document, and this can be found on a website called lgpsboard.org. If you need that link, I can put it into the chat. And the Informa document, it runs to about 54 pages, reasonably heavy reading, so I wouldn't read it all at once, but it's, if you want to take part of it and just pick out what's relevant to you, then you can. It was issued back in June, so about 10th of June. So when you get onto the landing page for lgpsboard.org, you can scroll down and it's there around the 10th of June. Alternatively, something which I find really useful just to help my understanding what the actuaries are reporting to us. A firm of actuaries called Hymans Robertson, who do the actuaries report for trusts in Hampshire. They've recently, at the end of August, done a webinar where they talk about next round funding in March 25, key assumptions like the discount rate on bonds, CPI, and how that impacts on the LGPS fund that you're going to see in your trust accounts. So it's about 45 minutes long, but I just find it really useful. It's very high level. It will just help you just to understand those disclosures that are being required to be put in your trust accounts. Again, if you want a link to that webinar, I'm happy to put it into chat. I say that LGPS document is there for you to basically pass around to your trustees. Moving on to counter fraud and prevention. So we had a chat from the ESFA, a guy called Stephen Graham from their counter fraud and prevention unit, who did attend the Auditors Forum, and he just gave us a bit of a breakdown of what they are seeing in the industry in terms of the areas of fraud that were mostly concerning them and they were seeing the most frequently. In no particular order, so still bank mandate fraud is still one very common. So this is where an external, a fraudster, purports to be an external supplier and requests to change the bank details. So really, this is, do your staff know when you get a call from an external supplier what the protocols are, what the policies are to make sure that the right checks are done, so they don't just go and change the wrong bank details for at a fraudster's wish. Phishing emails, still very common. I'm sure you get loads of them. At HWB, we actually do test emails on our staff to check that we send them bogus phishing emails to see whether they're alive to it. And if they fail those, then they have to do additional training. So that might be something you might want to consider in your trusts, because it is on the increase. Abusive position, so recruitment of friends, families to roles, related party fraud as well, which is why that sort of document, that related party checklist, is so important to make sure you get that right before carrying out related party transactions. Theft of assets, so school funds misappropriated, and the final one, financial mismanagement, so inflation of numbers to access additional funds, perhaps for the trust. And the final subject from the Auditors Forum was from time to time we do get example questions, or we get someone from the audience just asking something which is relevant to their trusts. So last year we would have covered in the Academy Accounts Direction part of our presentation that they were keen, or there's an expectation that trusts would have interim arrangements planned in the event of departure or long-term absence of key roles at the trust, particularly accounting officers, because of the importance of their role. The trust in question, the accounting officer, was unfortunately off for long-term sick leave. They didn't have informal or internal arrangements in place. There's nothing in place, so they needed to act fairly quickly. The feedback from the forum really was, well, a couple of options. Next most senior person of the senior management team takes up the interim position, or secondly, the CFO takes up the role on the basis that they would most likely be able to understand the regularity requirements. Now, there is a part in the handbook that says a CFO and accounting officer should not be the same person. So if this second option was one that your trust was considering, you'd need to make sure that there was clear delineation of the responsibilities, so that CFO could not step back into their CFO role whilst the interim arrangement was in place. I think the ESFA's view on it was, yeah, these are all fine. However, please do contact us and talk to us about who the right person for the role will be, because they will have a view on it as well. So just bear that in mind. Okay, so that's the end of my part. So if you do have any questions, please do put them in the chat box. As I mentioned, the trust handbook has been issued, so I think Matt's going to be covering that next. So back over to Matt.
Perfect, lovely, thanks Gary. Yeah, so now I'm going to talk you through a summary of updates to the ESFA's Academy Trust Handbook, or ATH, which was released on the 31st of July this year, along with the ESFA Scheduler Musts, which came into effect from the 1st of September 2024 and covers the 24-25 academic year. So again, I'm sure all are aware of the handbook, but in general, it describes the rules, if you like, of the financial and other responsibilities and requirements that Academy Trusts must adhere to in accordance with their funding agreement. So the primary users of the handbook are those with responsibility for the governing, which will be yourselves, managing, which will be your finance teams, or auditing, which is where we come in, of an Academy Trust. So as Gary mentioned earlier, the ESFA have deliberately limited the number of changes in this year's edition following feedback from the sector that a period of greater stability would be welcomed, especially due to the delay in publishing the handbook because of the general election. That being said, I'm pleased to say that there haven't been any major changes this year, but there are a small number aimed at simplification and strengthening controls and oversight, which I'll run through now. So firstly, with regards to roles and responsibilities, which reminds trusts of the importance of digital and technological standards. So our suggested action here is that yourselves as trustees on the board should refer to the DfE's digital and technology standards to ensure you're able to make informed decisions about this area. Secondly is with regards to two changes in main financial requirements. So one is emphasising that trusts reserves policy includes a clear plan for managing reserves. Would suggest here that you should continue to ensure you have short-term and long-term financial plans being prepared and monitored and have an up-to-date policy for holding reserves in line with the aspects that I mentioned earlier, which includes a clear plan for managing them. We can then ensure that appropriate disclosure is included within the financial statements when we come to prep the accounts included within your trustees report. The second point there is clarifying the position around when trusts must approach the ESFA for electric vehicle salary sacrifice schemes. So 10 days ago, 1st of September 24, ensure your trust obtains pre-approval from the ESFA before entering into any new schemes or accepting any further employees into existing schemes, due to the ESFA pausing their position on these schemes recently due to cross-government discussions. The next change is with regards to internal scrutiny and explains which internal scrutiny options are to be applied for trusts with annual revenue above 50 million. So here, where relevant, you must continue to ensure your trust delivers internal scrutiny in the way most appropriate to its circumstances. And there's various options on how to achieve this included within the handbook. Also, so thinking a bit of forward planning. So from the 1st of September 25, so relating to your 25-26 academic year, was a further change I just wanted to mention. So there's going to be a requirement for trusts with an annual income above 50 million, where it used to be a should for having an in-house internal auditor and or bought-in internal audit service, and that's going to become a must. So where this is applicable to your trust, you need to plan ahead really to ensure compliance from the start of your 25-26 academic year. So yeah, not this year, but next year. The handbook also clarifies which qualifications and or experience is needed for trustees and peer reviewers when they become the internal scrutineer, completing the IS work. So you can ensure that those carrying out the programme of internal scrutiny meet the qualification and or experience criteria as per the handbook. And ultimately, there has been an update with regards to delegated authorities, which confirms that trusts will be able to enter into finance leases where the lease category appears on the DfE basically pre-approved list. This comes about due to a new international accounting standard being introduced on 1st of April, which has prompted some welcome simplification in respect of leases for academies. Historically, just to cover, there have been two different classes of leases. So firstly was operating leases, which are generally for a shorter period of time, don't provide an option of ownership at the end. The costs went through the statement of financial activities, so the SOFA, and were previously allowable for schools. The second were classed as finance leases. These generally transfer the asset to the lessee at the end of a lease term, were included as assets and liabilities on a balance sheet, and then these required prior ESFA approval due to the borrowing nature inherent in these type of lease. So for Academy Trusts, this new list of approved leases apply from the 1st of September 24, just gone. So a few other types of assets which have been granted prior consent by the Secretary of State include all existing leases in place before the 1st of September 24 for items on the list. And then a few, there's a much longer list, but a few just to mention. So leases related to IT equipment, that include laptops, printers, photocopiers. Those related to telephony, so mobile phones and telephone systems. And then also leases related to minibuses and kind of other vehicles used for the school. So like I said, there are more examples. So suggest that you make yourselves aware of what is now included on the DfE's list and what is not, to basically just ensure the trust remains compliant with the new rules. So the actual effective date that this will be implemented into UK accounting standards has not yet been confirmed, but it will not be before Jan 26. So for your trust, this will be August 27 year ends, so a little bit away. But don't worry, obviously near the time we'll send around more further guidance and updates to yourselves and finance teams just to kind of tide over and help with a smooth transition. Finally, the last section to have changes in this year's handbook is with regards to the regulator and intervention. And there's a couple of parts here. So first one's being clarification that trusts take appropriate action to meet the DfE cybersecurity standards. So here we'd suggest that you continue to be aware of the risk of cybercrime, like Gary mentioned earlier, and you take appropriate action to meet the DfE cybersecurity standards, seeing as cyber incidents and attacks can have really rather significant operational and or financial impacts on schools. And then lastly, the second section here is that there's one additional example has been added to this year's handbook, which lists out examples of where notice to improve may be issued to further what Michaela mentioned earlier. Again, just ensure that you do have an awareness of this extra item on the list and take appropriate actions where necessary. So yeah, that additional item reads as trustees and the executive failing to manage their school estate and maintain it in a safe working condition strategically and effectively. So this effectively builds on the fact that there's more emphasis being placed on estates management, which came in last year. So similar to the accounts direction I mentioned earlier, all of these changes have been summarised on a fact sheet that we've prepared and circulated earlier in the year. Again, we'll circulate it around following this evening's seminar. So I have seen a few questions, but I believe are being covered, but obviously we'll check afterwards. So yeah, just leaves me to say thanks very much for listening, and I'm going to pass back to Michaela, who'll be going through a few changes coming up. Thanks so much.
Lovely. Thank you, Matt. So we thought it would be useful just to finish off very briefly on areas that you should have on your sort of horizons, things that are up and coming that you should be starting to talk about. So I thought I'd start with decarbonisation. There is a public sector decarbonisation scheme, and that's obviously related mainly to the education estates, your properties. And the DfE obviously have this net zero ambition, which is driven and based on UK government legislation to meet net zero by 2050. And so we all, want to comply with this, and we've seen obviously in academy schools up to now some of the sort of more green investments where they've been backed by Salix loans, which tend to be sort of energy efficiency type loans that have been set up. So we've seen a little bit of this, but I think it's going to pick up a pace as we get nearer and nearer 2050. So it's worth just sort of being aware of the DfE strategic aims, which I'll just sort of read out to you. And they're around preparing all young people for a world impacted on by climate change. Number 2 was reducing direct and indirect emissions. Number 3 was resilience to climate change and adapting buildings. And number 4 was enhancing biodiversity and improving air quality. So those are their aims, and I think obviously that's going to come down through via legislation in all different ways. But I suppose the question to you as boards now is what are you doing? Have you developed your sustainability policy? Have you addressed your your need and your compliance around Scope 1 emissions, which is sort of quite close now, and trying to make sure that whatever plans you do put in place with your teams, they are achievable. And then on top of all of that, they're wanting you to sort of weave that into your curriculum and support and encourage that green ethos within your, both your staff and your students as well. So yeah, just very, very brief touch upon it. Some of you might be very, very pro, some of you might be very anti, but it's coming. So I think it's best to try and grab it and start making some plans, no matter how high level they might be at this stage. The next area, obviously, is we're all now dealing with a new government, and that usually means change. So you looked at what Labour have put out in their policies at the moment, which is very little, but their sort of high level statement was that they wanted to modernise the curriculum, but build on knowledge and rich successes. And then that again was sort of reiterated in the King's speech, where the topics being mentioned there were around teacher recruitment and retention, SEN, early years and childcare, and of course further education. So at the moment we're all waiting to see the detail, and how that's going to affect us personally and affect the schools that you're in. So we've got the budget day coming up on the 30th of October, where we might see some announcements. So far, really, what have we seen? We have seen changes to the Ofsted sort of one-word assessments that were being given to schools. And we think there may well be some changes to the timings of the salary announcements, which might help your budget forecast returns, or it might hinder. Don't know which way it's going to go. Certainly, we're seeing local councils feeling the squeeze, some of them going into deficits. And if any of you still use any of the local councils for any service level agreements, I'm sure there is going to be a plan to phase that out over a period of time, because as less and less Academy trusts are using the councils for support, there is less and less need to have that service there. Okay, and then the final topic was around the Procurement Act 2023. And this one is actually quite imminent, really. It comes into effect on the 28th of October this year. And so, is your Academy Trust ready? This legislation, the Procurement Act, has been updated with the aim of making sure that public monies are spent wisely. But unfortunately, there has been no changes to the actual procurement limits that are already in place. We have a fact sheet on those procurement limits, and we send that around to Academy Trusts. It used to be called the OJU limits when we were in the sort of European Union, and now those limits apply to what is called a find tender service. So that service that currently exists will be updated shortly onto what's going to be called a central digital platform. And some of the changes under the new Act will come into place immediately, and others will be phased in. So our advice to you is that if you have any contracts coming up for renewal, then you need to decide if you want them to be run under the old rules that everyone is familiar with, or under the new rules. So those tenders could be anything from, catering contract, cleaning, an extension, a new build that you're having done. So any of those sort of contracts, you need to try and make those decisions. So you've only got up to the 28th of October to do it under the old rules, or you can, once you've started, you can continue in those rules. Otherwise, you'll have to go under the new rules. So as trustees, you should ensure that your policies and procedures around procurement have been updated and have been approved by you as a board. And that will mean that your business managers, your CFOs, will need to have attended a 45-minute training session run by the Government Commercial College, and it's called a knowledge drop. And then in addition to that, if you're large enough to have a procurement manager person in your trust, they need to complete some e-learning modules, which is then followed by a test. And this takes about 15 hours. So you do need to put some time aside in order for them to be able to achieve that. So I've put up there on the screen a couple of links to some good guidance documents that are available. And so that you can then, help build your policies and procedures around that. We will be going through this in more detail with your business managers at our next Academy Forum on the 26th of September, so that we help get them prepared for these changes. Okay, so I thought that we would just do our final poll at this point, just so we have sort of some awareness of whether your trust has done this knowledge drop training for procurement. Don't know if any of you know. That'd be good just to get that up. I'll leave that running for just a couple of seconds. Great, well, it's good to see that some of you have already. I always think it's good to be prepared. Okay. Well, I hope that we've answered all your questions that have been in the chat, and that we've given you some topics for you to think about. And we will be setting dates for next year's webinar shortly. We run this only once a year, and we think this is a good time, but please do feedback to us if you think a different date would be better or a different time. We are very conscious that all of you as trustees do this as a voluntary role and probably have been at work all day already. In the meantime, if you'd like to sign up for our Academy newswire, we send out a communication every month, which hopefully helps you keep up to date with what the latest changes are. Then please do let us know and we'll make sure you're on the list to receive that. So if there are no further questions, then I will bring the session to a close and wish you all a smooth run up to Christmas and your year-end audits. And as promised, we will send over the live link recording and the documents that we've mentioned and a copy of these slides so you can share them with your trusts. Just leaves me to say thank you all very much for attending tonight and wish you a good evening. Goodbye from everybody at HWB.